Hey guys, make sure you do not set up a limited company until you watch this video. Hi guys, in the next few weeks I'm going to be exploring the benefits and the disbenefits of using a limited company as a property investor. That's right, I want to be looking at the structure, the tax structure of using a limited company to hold your property portfolio. Now, it's easy and tempting if you've been to networking events or you've looked at YouTube videos or LinkedIn posts or even Facebook posts for you to think, well, should I use a limited company? And most of the people that have been advising you are basing it on everything that they understand about themselves, not about you. And therefore, you need to make sure that you take an informed decision about your own personal circumstances before you go rushing off and setting up that limited company, which you could just regret later on. So make sure that you set up a limited company only when you get proper advice. But this video should hopefully help you understand whether a limited company is useful. So a limited company, what is a limited company? Well, a limited company is a separate entity from yourself. That means it is shielded from a risk perspective. You see, if you have a property in your own personal name and something goes wrong, that tenant could sue you as an individual. But if you have a limited company that owns the property, the legal responsibility resides with the company rather than you. Which means that if the tenant does sue the company, it can only take the assets in that company. It can't take any more assets from you personally. So that's a great advantage in terms of shielding all of the risk that might be going against you as a property investor landlord. Let's talk about Section 24 and limited companies. Now, I have done another video, so make sure you pop your finger on this video talking about Section 24. There's a lot more detail there than I'm going to go to today. But I'm going to position this a like-for-like comparison of owning a property or even properties in your own name versus if they were held inside a limited company. And I'm going to explore that with an example for you to get some good ideas of whether a limited company is right for you or not. So let's have a look at Section 24 and what it really means. And what I'm going to do is a direct comparison against a limited company from the April 2020. Because April 2020 is a significant month whereby corporation tax rate falls to 17%. That's a bonus because that's 3% less than the income tax band for a basic rate taxpayer. So it's a lot better for you. Now what I want to do is look at a position whereby you've got rental income in your personal name or indeed a limited company. And you can see that it's £100,000. Now what I've done is I've put £50,000 worth of mortgage interest against you as an individual. So that's the kind of buy-to-let mortgages that you might get in your own name. However, I've increased the mortgage interest cost, which you can see there. And that is because I believe that the mortgage interest cost that you'll have inside a limited company will be more than if you buy a property inside your own name. And that's because banks want to de-risk their debt. And as a result, they're going to have to make some sort of compensation, which is increasing the mortgage interest rate to you as a limited company owner. Which means more mortgage interest rates means more mortgage interest costs, which means clearly you'd be making less profit from your property portfolio. But let's not forget, what we're trying to do here is look from a tax perspective, but we can't forget that just because we're trying to save tax, we don't want to be kind of taking money from HMRC only to give it to the bank. So you do need to make sure that you understand what are the buy-to-let rates that you can get in your own name versus that in a limited company. As a result, you can see here that you've got £40,000 worth of net profit in your own name versus a lower taxable profit inside of a limited company at £25,000. Now that's all because mortgage interest, but let's think about this. We know that Section 24 disallows mortgage interest costs as a genuine cost to you as an individual. Therefore, unfortunately, we've got to add back that mortgage interest cost to give you the taxable profit, which you can now see on your screen. Which, when we look at the calculation, we are going to be taking the new taxable profit, which is not obviously real profit, is it? Let's be fair. It's not cash you've got. It's paper profit based on the HMRC tax calculations for Section 24. As a result, that means you're going to be paying 40% on this new taxable profit, which means you're paying out a lot more tax, as you can see here, compared to the tax that you will pay in a limited company. So in effect, the tax rate is a lot higher in your personal name versus 17% in a limited company structure. So in your personal name, now you've got, after all these new tax changes, you've got £14,000 left of all of these profits that you've made. Now, let's compare that inside a limited company, because right now, that money you can see there is sitting inside a limited company. And if you are investing for your lifestyle purposes and you wish to extract all of that money out of that limited company, we need to make sure we know a direct comparison of how much tax you could be paying in total. So you've got the limited company, which is paying corporation tax, but now we've got to think about, well, if you're extracting all of that money, you are personally going to have an income tax charge too. So how does this affect you? Well, luckily, the first £2,000 worth of dividends that you take out will be tax-free. So £2,000 worth of dividends are tax-free. Brilliant. However, the rest of the money that you're extracting outside that limited company, and we're making the direct comparison here of high rate taxpayer versus high rate taxpayer, aren't we? So we have to do the same calculation. Now, as a high rate taxpayer, you'll be paying 32.5% income tax on those dividends that you extract outside of your limited company. And you can see how much tax you're now going to be charged as a result. And if we take the combined, the personal tax from extracting dividends out and the tax that the company has already suffered, you can see here quite clearly that the amount of net cash that you could be receiving after the additional mortgage interest from the limited company and the tax, the net cash position is, funnily enough, similar to if you didn't have a limited company structure and you accepted that you're going to be paying all that additional tax. And we can't forget the fact that you are now a limited company owner, which means, yes, you've got additional accountancy costs to take into account. You have the extra burden of submitting company accounts to Companies House. You've got the extra burden of tax returns that needs to be submitted to HMRC, and you've got the annual confirmation statements as well. That is a lot of administration for you to take on board when you're not getting that much benefit anyway. So the question needs to be answered, what was the point? So before going any further, can you see how the Section 24 is going to affect you personally? Make sure that you type in yes below and let me know how much Section 24 is going to affect you. And equally, can you see the logic behind this limited company structure and it's not really benefiting you? In fact, have you been told to set up a limited company? And if you have, type yes in the comments box below and make sure that you let me know, because I want to make sure that I answer all your questions, but I also want to make sure that I can iron out some of those queries and concerns that you might have before you launching yourself into a limited company structure. But I wanted to now make another comparison where we're saying the person that owns the limited company does not want the money from the company for their lifestyle purposes. And in fact, they're quite happy to invest that money into more properties inside their company structure, so building their portfolio quicker. Now, as I mentioned before, it would be sensible if you're making profits outside of your limited company to extract those £2,000 worth of tax-free dividends out. Why not? If you choose to put the money back inside the limited company, it would be a loan to the company, which you can extract anytime you wanted, and it'd be tax-free. So why not take it out of the company tax-free and then loan it back to the company again, increasing your director's loan account. It's a great example of how to manage your personal wealth as well as the company wealth. And hopefully you can see by this example that this person who's got the limited company is happy to keep the money inside the limited company to reinvest in properties and therefore have no income tax on the money that they're extracting at all of the £2,000. So there's less corporation tax, which means this structure really works well. If you've got a limited company which you are going to be using for lifestyle purposes, do not use it. If you're extracting all the money out, do not use it. If you, however, want to build wealth for yourself, then it would be far better to make sure that you can keep your property portfolio going and developing inside that limited company. I want another consideration in your mind. If you've set up a limited company because you're a high rate taxpayer and you've got a property investment portfolio growing inside of it, and in this example here, you can see that you're paying the additional mortgage interest costs because banks want their extra money to de-risk their debt. If this is happening and you're paying all this accountancy fees, only for you to think, well, within 2-3 years, I'm going to be leaving my job anyway and relying on the property investment income, I rather suspect that the amount of bank interest that you're forking out for it to be in a limited company, the extra accountancy fees, would be totally wasted. Why? Because potentially, if you're going to rely on your property investment income in your personal name and you bought all your properties inside your own personal name, then you may have saved yourself the extra administration burden, the extra interest costs for having a limited company and the buy-to-let mortgages inside of it, and all the accountancy costs. Because Section 24 may not even apply to you in 2-3 years' time if all you've done is removed yourself from employment. Let's not forget, the sole reason to use this structure is because of the Section 24 mortgage interest relief costs. So ultimately, you could be burdening yourself unnecessarily. So do think about this. Before you're rushing off setting up a limited company, do think about a couple of things. One, how long are you going to stay in your high paid job? If it's not going to be for very long, and you're thinking about, well, 2 years, 3 years, I'm going to be exiting my job and the property income is my sole income, then forget it. Do not use a limited company. Second of all, you may be thinking, well, actually, I don't need the property income right now, but I'm going to bring other family members into my business, maybe my wife or spouse or still a partner. Well, you could do a lot of changes within your own personal name without having a limited company structure at all. So make sure that you take all things into account before you make your decision of investing inside a limited company or not. So then guys, has this video been useful? Has it made you think twice about setting a limited company? Please write down your thoughts, your comments, your concerns in the box below, because I want to know what's going on with most of the investors that we come in contact with. Are there any questions that you might have about using a limited company structure for your investment portfolio? I hope there are, because I want to make sure that I get those answers to you within 36 hours of you posting them. And I promise to make sure I'll do future videos about that kind of subject as well. to make sure that you make better tax decisions in the future. So don't forget, guys, make sure you come and join me at the property Q&A on Monday evenings at 7 p.m. till 8 p.m, where I'll be answering any property investment questions that you might have, or indeed, if you've got property tax questions, feel free to type those into the box as well, and I'll make sure that I answer them at 7 p.m. on Monday evenings. So stay tuned for that.